right. Well, thank you, Amy, and thank you everyone for joining us today. My name is Stacy Nelson. I am a partner here in our Sioux Falls office, and I am also a member of the Nonprofit Technical Issues Committee. So as we were kind of putting together content, today is the first of our three-part Fall Nonprofit Standards Updates web series. So today we're going to be talking about revenue recognition and the lessons that we've learned. So you might feel like we've been talking about revenue recognition for 2 or more years, which would be true. We have been talking about it for a while. And now we have reached the point where most of our entities should have implemented. So we wanted to kind of circle back around and incorporate some real life examples that we've encountered and that are most common to our nonprofits, and some tools and reminders, as well as some additional examples of disclosures. So with that, we are going to start off, we're going to talk about exchange revenues. So those under 606, you might have seen it referred to as 606 exchange revenues. We're also going to talk about contributions, conditional and unconditional, and that was that ASU 2018-08. And then we'll wrap up just talking a little bit about some of the COVID specific funding that our nonprofits have been exposed to or may have received during the year, and leave some time for questions. So as Amy mentioned, you can use that chat function or the question and answer function to send your questions. All right, so we're going to start off with exchange revenues. And when we think about nonprofits and what they might have for common exchange revenues, they might have things like tuition, room and board, student or program fees. It could be membership dues if you're a membership type association or organization. You might have some ticket sales, summer camps, conference income, even merchandise sales. So with our nonprofits, we can have a wide variety of different types of exchange revenues. The exchange revenues could also include certain research or other grants that if commensurate value is being exchanged between the two parties. So we'll look at some examples of that as we walk through, as well as special event revenue. So if we think about nonprofits, it's very common for them to put on galas or lunches. And as such, they may have a portion that is exchange revenue and a portion that is contribution as well. So we'll look at some examples for that too. So just some tools and reminders. The effective date for calendar year entities that were public nonprofits was 2019. If you were a non-public entity, you had until 2020 to implement. However, that being said, there was ASU 2020-05 that added a 1-year delay. So if you are an off year end, such as a June 30 year end, you may have had till June 30th, 2021 to implement 606. So just a quick reminder for any entities that maybe are still in that off year end and adopting, the first thing you are going to want to do is make sure you are identifying all of your revenue streams. So each source that you have coming in, looking at that to determine if it is exchange revenue, you are going to work through those 5 steps. And those again were to identify the customer, the performance obligation, transaction price, and whether it was overtime or a point in time. Now, if you have already adopted, that doesn't mean you're off the hook. You still need to continue to work this. So you would want to reevaluate your revenue streams. Did you have any revenue streams that fell off during the year? Or potentially maybe you had some new revenue streams that came in. So you're going to want to retain your documentation. So if you had put that together in the prior year for how you had come to the conclusion, you want to review that, update it for any new items, any assumptions and conclusions, and maintain that and update it each year. And that is likely something you'll want to share with your auditors. One other thing I did want to point out, it relates to terminology. So we'll frequently hear the terms deferred revenue and refundable advance. And when would it be appropriate to use both? So when we think about deferred revenues, this is generally going to be in relation to your exchange revenues. So this would be maybe amounts that you've received in advance for membership dues. If your membership dues maybe don't coincide necessarily with your year end, you would have a liability at year end, and that would be reported as deferred revenues. Refundable advances then, on the other hand, typically describe grants or contributions that have been received in advance. So those would be your non-exchange type of amounts received in advance. So one other item that we learned more about during the year with our nonprofits is principal versus agent considerations. So this is very common with performing arts types of nonprofits. where maybe you have a service concessionaire that's providing a food service, or it could be an education component related to that. So when you're looking at those agreements, the first thing you want to do is identify what are the goods or services that are being provided to that end customer and who has control over those goods and services. So when we talk about control and making that determination, there are some indicators that have been identified to use to help you identify who has that control. The first one relates to who will be primarily responsible for fulfilling that obligation. Who is going to be providing that good or service to the customer? Who has inventory risk both before the goods or service is transferred, so the risk of inventory loss, and again after, so the risk of potentially any refunds or returns. And then also who has discretion in establishing price. So when you look at these control indicators, you wouldn't look at them individually to make a determination. You kind of need to look at them all together collectively to make that determination of who would be considered the principal versus agent. So in a principal situation, the principal is going to have control over those goods and services, and they are going to report their revenue at gross presentation. So an example of this would be, say we have an entity, let's call them Center for Arts, and they're selling tickets to a customer for a performance that's being put on by the center's students. So in this particular instance, the center is responsible for providing that performance obligation, and they are going to record the revenue at the total cost of the ticket. An agent is going to maybe arranging for the provision of the goods or service by another party. So you are not controlling the goods and service, and agents are going to report their revenue at net presentation. So if we take our same example, our Center for Arts, this time, let's say they are selling tickets to a customer for a performance put on by the local symphony. So the symphony is going to be responsible for fulfilling that performance obligation to the customer, and the symphony has the risk. So in this example, the symphony, the center would be considered the agent, and they're only going to report the commission that they keep on the portion of that ticket sales. And we have some more examples that we'll walk through related to this as well. All right, very common for our nonprofits to receive sponsorships in relation to specific events that they put on. So we have an example here. We have Company C who's agreeing to sponsor the nonprofit's annual fundraising banquet, which is honoring women in business, and they're sponsoring at the platinum level for $15,000. So as a sponsor at this level, Company C is going to receive a table at the banquet, a one-page advertisement in the nonprofit's quarterly newsletter, and also recognition in the annual report. So how would that $15,000 sponsorship be recorded and allocated? So when we're looking at that, if we remember back to our exchange, our training on the exchange transactions, we're going to allocate the transaction price based on if we have standalone selling prices. So this particular nonprofit, you can purchase a table at the banquet without being a sponsor. In that case, they have assigned $1,000 to be considered the table or the special event revenue, and that would be recorded at the time of the event. Similarly, the advertisement and newsletter, they also sell that outside of a sponsorship, so they have identified $2,000 of that as being advertising revenue. And again, that was quarterly, so they're going to recognize a portion of that each quarter as that advertising is being provided. The remaining amount then, $12,000, would be considered contribution revenue, and that would be recorded at the time of the event. So if we also think about this, this particular revenue or the contribution, would that be considered restricted? Well, it's going to depend on whether the purpose of this event is more narrow than the overall mission of the nonprofit. If it is more narrow, then you would record it as restricted contribution. So let's take our same example here and just twist the facts a little bit. What if the receipt of the sponsorship and the event are occurring in two separate reporting periods? Let's say, for our example, they've collected the sponsorship in December, but the event isn't going to happen until January. So in that case, the table at the banquet, that $1,000 of special event, that's going to be recorded as deferred revenue in December when it's received. Similarly, the advertisement in the newsletter would be deferred revenue as well. The $12,000 of contribution would be considered a refundable advance because that is conditioned upon that event actually happening. Now, we are living in the environment of COVID. It has not gone away. Many of you may have experienced the similar situations. What if the event eventually gets canceled in January and you aren't able to hold it? Then what do you do with these amounts that you have recorded as liabilities? The first thing you're going to do is to reach back out to the sponsor and see what they want to do. Do they want the entire $15,000 amount refunded back to them? Maybe they would like you to hold on to that $15,000 sponsorship for a future event. In that case, you would just leave those recorded as liabilities. Or maybe the sponsor has decided, hey, you still have operating costs. You're doing good work in the community. Go ahead and keep that $15,000 as a contribution. So if that were the case, you would then remove those liabilities from your statement of financial position and record them as contribution revenue at that time. All right, how about a membership example? So we have Association A that's providing its members with an assortment of benefits, including professional development through training, which is an access to a training library and even live events. They have a monthly magazine, and they're also receiving lobbying and advocacy on behalf of the industry. So the annual dues for those members are $2,500. So how would that $2,500 be recorded? So again, you're going to look to standalone selling prices if they have. So they do sell training to outside organizations that aren't necessarily members. So they've identified that 1,250 of the dues would be considered training, and that would be recorded as program revenue at the time those services are provided. Monthly magazine, similarly, individuals can subscribe to the magazine without being a member. So they've identified $120 of that being related to the magazine, and that would be recognized over the 12-month period. And then the remainder amount would be considered dues revenue, and their dues cover a 12-month period. So those dues would be recognized over those 12 months. All right, so here's our example of a principal versus agent considerations. So we have Children's Zoo, which is contracting with a third-party concessionaire to manage their ticket booth, gift shop, and concessions at the local zoo. The concessionaire is responsible for hiring and staffing each of those areas at the zoo. And in addition, they have full control over gift shop and food inventory. So as a result of this arrangement, the concessionaire is earning a commission on the sales. The zoo's revenue streams include each of the following, and how would each of them be recorded on the zoo's financials? So when we look at these considerations of whether the zoo is principal or agent for each of these streams, we need to first look at that performance obligation. Who is responsible for fulfilling the services, goods or services to the entity, to the ultimate customer, and who has control? So in looking at membership dues, the zoo would be providing the end service, the experience of visiting the zoo to the customer. So they are going to be considered the principal in this transaction. And they are going to recognize that revenue at the total membership due cost over the 12-month period. So in this case, the commission that they might be paying to that third-party concessionaire would be shown separately as an expense in their statement of activities. Similarly, admissions, the zoo again would be responsible for fulfilling that obligation instead of an entire year's recognition period. They would be recognizing that at the point in time. And again, the commission would be recorded as expense. As we look to concessions, we know that in this case, the third-party concessionaire would be providing the service to the customer. They are providing the food back to the customer. And as such, they also have the risk over the inventory. So they're going to record, the zoo would record their revenue related to concessions, so their piece that they get to retain from the sale at net. So they're not going to record the full transaction cost of the concessions, but really what portion they keep from that. And the gift shop would be the same as concessions. You're going to record that at net presentation. The third-party concessionaire is responsible for providing those goods and services to the customer. All right, so disclosures related to revenue recognition. As you may recall, there was a significant amount of additional disclosures that were required for non-public entities. This includes disaggregation. So what we've seen over the last year in reviewing and auditing some of our clients is making sure you are including the level of detail that you need in the financial statements. So if your financial statements, your statement of activities, if it's reporting one line item for program revenues, you need to make sure then in the footnotes to the financial statement that you are providing disaggregated information about those program revenues. So if we think about our previous example with our children's zoo, you would have to include information for each of those revenue streams. How much was memberships, admissions, concessions, and gift shop? And again, that could be either in the footnotes to the financial statements, or you may include that level of detail in the face of your statement of activities. The footnotes also need to include information about your contract assets and liabilities. So you're going to include the beginning balance for all periods presented and the ending balance for all periods presented. So if you have comparative financial statements for 2021, say you're a calendar year entity, you're going to report those balances as of 12/31/2021, 12/31/2020, and then also the beginning of that period, which would be 1/1/2020. And that can be provided either in a narrative format or in a table in the footnotes. Your revenue recognition policy, you need to make sure you are including enough information about each of those revenue streams, including how and when the obligations are being satisfied, again, by each of those streams. What are the specific payment terms? Do you have any discounts that may be applicable, or refunds or non-refundable amounts? The nature of the goods and services that are being provided and included. And again, making sure you're including information about those contract assets and liabilities. So your accounts receivable and deferred revenues. If you are a public entity, you have to include all of the information above plus much more. We have not included the detail here for all of those disclosures as such, because if you are a public entity, it's already been implemented for a couple of years now. So just a reminder too, that a public entity for a nonprofit would be one that has issued public debt that is being traded. All right, so we've talked about exchange revenues. Now we're going to talk a little bit about conditional versus unconditional. So ASU 2018 provided guidance on when you have exchange and non-exchange transactions, and also provided clarifying guidance on when a contribution would be considered conditional. And this is important because the determination between conditional and unconditional is going to determine what point in time those revenues would be recorded. So as we think about contributions, it could be, your promises made by donors, it could be private grants, or it may even be federal and state grants and agreements. So what is a conditional contribution? So that needs to include both a right of return and a barrier. On our slide here, we have some examples of what the terminology or what that wording might look like for a right of return. So we have the first example there. Payments are subject to your compliance with this agreement. It could be wording such as before payment of funds can be made, or it could include wording such as the foundation shall reimburse the organization for actual and authorized expenditures incurred in satisfactorily completing the scope of work and fulfilling those contract requirements. So there's several different forms that type of wording may take on for the right of return. Now, on the flip side, the other thing that we need is a barrier. And there are 3 different types of barriers. The first one is a measurable performance related barrier or other measurable barrier. So there are 4 subcategories underneath of there, which might be things such as a specified level of service. Maybe you need to provide 500 meals a month under your agreement. It could be specific outputs, placing X number of people in jobs. It could be a matching requirement where a donor has promised to give you $15,000 if you can raise another $15,000. Or it might be a specific protocol that must be adhered to. For example, maybe you received a grant for construction and your building needs to coincide or be built under certain environmental standards. The third item there is whether a stipulation is related to the purpose of the agreement. So this is going to exclude any of those administrative type things where you're required to submit a budget or submit an annual report or an audit. Those items are not necessarily related to the purpose of the agreement and would not be indicative of a barrier. So just a reminder, you would need to have both the right of return and a barrier in order for the contribution to be considered conditional. And those the wording of the right of return and the barrier would need to be included in your grant agreement or in your donor letter, your award letter, to be able to be considered conditions. They need to be either within the agreement or referenced to within the agreement. So an example of where it might be referenced is very common, I see with like our HHS grants, so Health and Human Services grants. In the award document, it will reference to HHS terms and conditions. So while those terms and conditions are not included actually in the award letter, they are making reference to it and they would be then looped in, and you would need to read those as well to determine if there were any conditions, excuse me. So here is another slide, just kind of gives you an example of some items that would be considered a barrier versus those that would not be considered a barrier. So under the yes column, we have reports conveying research findings on a grant for specific research. So that's it's very specific to the purpose of the agreement. Alternatively, the top one on the no side, you've got a report indicating how the grant funds were spent. That's really an after the fact reporting and not really related to the purpose of the agreement. The second item under yes, a requirement to meet specific targets each quarter. So again, that's kind of those meals, people served, et cetera. Under yes, we've also got the requirement to incur expenses in compliance with rules and regulations established by OMB. So those are those cost principles that's limiting the discretion on how you can spend those amounts. So that would be a barrier. Flipping back over to no then, our second bullet point, we've got the requirement for an annual audit in accordance with OMB guidelines. Again, that doesn't really relate to the purpose of the grant. The nonprofit being a 501c3, that's really administrative, not necessarily related to the purpose. To use the funds in accordance with the grant budget, or the requirement to use funds for salaries and wages, or to use for programs expenses. Those are very generic in purpose and therefore would not be indications of a barrier. Under old nonprofit GAAP or under the old rules, probability of meeting a barrier or likelihood of meeting a barrier was a consideration. This is no longer a consideration under 2018-08. You are no longer going to make those assessments to determine if you have a condition. So that's a change from previous GAAP. So we've talked a little bit about conditions. Wanted to also talk a little bit about revocable type wording. So if you have an agreement that has the wording something like the following: the agreement may be terminated by either party upon giving 60 days written notice. This agreement can really be canceled by either party, and as such, it would not be recorded until those amounts have been received, because either party could change their mind and back out of the agreement. Another thing that we see very common with our nonprofits is agency transactions, and this can take on many different forms. It could be wording such as fiscal agent, fiscal sponsor, or project sponsor. Could refer to an intermediary where you're acting as the facilitator of the transfer of those assets between a donee and a donor. And to know when you need to record the revenue and expenses. Well, you are going to record the revenue and expenses related to those type of agreements when you have variance power. So does the nonprofit or the entity in question have discretion in determining how those amounts are going to be spent? If yes, you are going to record that revenue and expense on your statement of activities. If not, if you're simply just administratively processing the grant, cutting checks, you are going to record an asset and an offsetting liability. So if you are looking to enter into one of those agreements, make sure before you sign on the bottom line that you have an understanding of how that agreement might affect your financial statements. So here is an example of a fiscal agent. We have Small Town Association, which is not a 501c3, and a nonprofit that have entered into an agreement where the association has established the Small Town Fund. The nonprofit's going to hold and administer all the property donated to the fund. The purpose of the fund is to provide for the construction and maintenance of a town park. The nonprofit has no control over how the funds are spent. The association is going to provide the nonprofit with a list of disbursements weekly, and the nonprofit's going to write the checks. So how would this be accounted for? Well, kind of the key thing in the wording above is that the nonprofit has no control over how those funds are being spent. So the conclusion is they do not have variance power, and therefore they would not be recording the revenue and expenses. They're going to record an asset for those funds as they are received and a corresponding liability. And then as the amounts are spent down, they're going to reduce the asset and the liability. So what if we switch the facts a little bit and to say that the nonprofit does have discretion in how those amounts are being spent? In that case, they would recognize revenue for those funds as they're received and corresponding expenses as those amounts are paid. So some challenges or changes under 2018-08, excuse me, might be the temptation for both resource providers and beneficiaries to add barriers to an agreement to get the desired outcome. You might have development teams. They generally have a different mindset on managing their gifts. They might be trying to meet their fundraising goals in one period or the next. So you need to make sure you're not taking that stance, that you're really looking to the substance of the agreement to determine if you have those conditions. There are certain items that previously were viewed as barriers that have been clarified and now are not considered to be barriers. Those are the things such as the budgets, the annual reporting, the filing of reports, and administrative type tasks. And then in addition, you may have some items that previously were not viewed as barriers because of that likelihood assessment, but now would be considered barriers. So you're no longer going to take in that probability assessment, and it's no longer a consideration in determining whether you have a conditional contribution. All right, so let's look at an example, a grant from a foundation. So we have a nonprofit that's awarded a grant from a private foundation. The grant agreement is requiring the nonprofit to provide therapy to 250 individuals that have been affected by trauma during the next fiscal year, and it has specific minimum targets that must be met each quarter. There is a right of release from the obligations in the agreement, and an audit must be performed and submitted at the end of the fiscal year to the foundation. The nonprofit is receiving the funds at the time the agreement is signed. So would this be conditional or unconditional, and how would that be recorded? So this particular grant would be considered conditional. We have a specified level of service that we are required to provide, that therapy to at least 250 individuals with minimums each quarter. And it also included the right of return and release language. So while there is an audit requirement included in there, that alone would not be considered a barrier to entitlement because it's not related to the purpose of the agreement. So this particular agreement was received upfront at the time it was received and signed. So that's going to be recorded as a refundable advance or a liability until those conditions have been met. If we take kind of those same fact patterns, but twist them just a little bit, instead, let's say we have to provide therapy to individuals affected by trauma during the next fiscal year with suggested targets met each quarter. There's still the right of release and still the audit requirement, and we're receiving the funds at the time the agreement is signed. So how would that affect our answer? Well, in this case, the grant would be considered unconditional. So while there are suggestions as to who and how many they serve, there are no requirements. We have the right of return, but again, without a barrier, the right of return does not matter and that would not be considered conditional. And again, the audit requirement would not be a barrier either. Since the funds were received at the time, those would be recognized at the time the grant is received. You would recognize the contribution revenue. And then you would go into the consideration too, would that be restricted revenue or without donor restrictions? So that's going to depend on whether providing those services to the individuals is more narrow than the overall scope of the organization, or if it's within their mission. All right, let's look at a grant from a foundation. So we have a nonprofit prepared a grant proposal requesting funds for their after-school program. The nonprofit was awarded the grant from a private foundation in the amount of $50,000, and the grant agreement recommends the nonprofit to hire 4 additional staff to run this after-school program. They're going to buy snacks for 100 children over the course of a year. The grant doesn't specify that their entitlement to the $50,000 is dependent upon meeting any of those recommendations if the funds are used for the after-school program. It does contain right of return if the funds are not spent on the particular program. So how would this one be classified as either conditional or unconditional? In this case, our grant is unconditional. The grant included specific recommendations, but again, it didn't specify that the entitlement to the transferred assets were dependent upon meeting those recommendations. The grant doesn't contain a barrier to overcome and therefore would not be considered conditional. All right, so I wanted to kind of provide an example too of what this might look like within an actual agreement. So we have taken excerpts from an agreement that we have reviewed over the year and provided that today just to kind of talk through. So I've highlighted some of the key elements and wanted to see what conclusion we would come to under this particular grant agreement. So this was from a foundation. Under one, we can see that the purpose was to create a collaborative staffing pool. We can see that it's going to come in 2 payments in 2020 and 2021. Under number 4 here, we've got to submit progress reports, evaluations, and complete financial reporting. Those are going to be considered administrative in nature and wouldn't of themselves be considered a barrier. Under number 6, we can see the grantee needs to be a 501c3 organization. Again, that's not related to the purpose of the agreement, so that would not be considered a barrier. Under number 7 here, to use the funds only for the designated purpose. So this would be more of a restriction. It's not necessarily limited discretion on how the amounts can be spent. It's really that they needed to be spent for this designated purpose. So that would not be a barrier. Under 8 and 9, we've got some wording talking about repaying a portion of the grant which is not used for the designated purpose, or returning those unspent or uncommitted funds. So those would be indicators of a right of return. And again, unless we have both a barrier and a right of return, that would not indicate a condition. And the very last item there, number 13, the grant payment may be discontinued, modified, or withheld at any time when, in the judgment of the foundation, such action is necessary to comply with the requirements. So that key words there is in the judgment of the foundation. That's really too subjective, and neither would that be considered a barrier. So the conclusion related to this agreement is that it is unconditional. It would be restricted because it had that specific purpose under the first part of the agreement, and it would be recorded at the time the agreement is signed. The full $200,000 would be recorded at that point in time. All right, so let's look at an example of a government grant. So as part of its mission, we have a nonprofit who's providing residential and counseling services to teens. The nonprofit enters into an agreement with the state to provide residential and counseling services to troubled youth as part of in the youth system. The specific individuals served are identified by the state. Would this be considered a contribution or an exchange transaction? So as we look at the fact pattern here, the state's payments to the nonprofit would be viewed as commensurate value between both parties. The state does not otherwise have a facility to serve the troubled youth, so they're receiving the benefit of not having to provide those services, while the nonprofit is receiving commensurate value for the services they are providing. So in this example, this would be considered an exchange revenue. If they received the money in advance of providing those services, it would be recorded as deferred revenue since it's exchange revenue. This is one of those examples where you think a government grant and you might think, oh, contribution, but you really do need to look to the substance of the agreement to see if there is commensurate value being exchanged. So if we take kind of the same fact pattern, a little bit different here. So what if instead the local city is providing the nonprofit with an annual subsidy for their teen residential and counseling service program, which can be used for any student that is served by the nonprofit? In this case, it would be considered a contribution because the city is not receiving any commensurate value. The city might indirectly benefit by helping the troubled youth in their city. However, it's not considered direct commensurate value. The nonprofit has discretion in how those funds are going to be used and whom they will serve. And so it would be recorded as a contribution. The question then begs, would it be restricted or unrestricted? Well, that kind of depends on the nonprofit. And if counseling would be more restrictive in the overall purpose, is that the main purpose for which the entity, the nonprofit exists? In that case, it would likely not be restricted. But if the residential counseling service is just a piece of what the overall nonprofit is doing, then it would likely be recorded as with donor restrictions. All right, here we have an example of an outside event. So near the end of fiscal year 1, our nonprofit received notice of a grant allocation from their local United Way chapter for $175,000 in fiscal year 2 and $175,000 in fiscal year 3. All of the funding amounts are contingent upon United Way reaching its campaign goal and are subject to final review after that campaign is complete. The awards are to be used towards the nonprofit's childcare program. So would this be recorded as A, the full $350,000 on the date the notice is received in fiscal year 1, B, $175,000 on 1/1 of fiscal year 2, and $175,000 on 1/1 fiscal year 3, C, on the date the nonprofit is made aware that the campaign goal is met, or D, as the amounts are received? Well, the answer here is it really could be C or D. So it depends on whether the nonprofit is made aware, if they would even know that the campaign goal was met. If they are made aware, then you would record the revenue on that particular date. If you weren't made aware, you would record the revenue as those amounts are being received. So this is an example of the outside event where something is happening outside of the organization's control, and that's one of those measurable performance barriers. All right, what about termination clauses? Well, here is an example of a termination clause. The foundation may modify, suspend, or discontinue any payment of the grant funds or terminate the agreement if the foundation is not reasonably satisfied with your progress on the project. Any grant funds that have not been used upon expiration or termination must be returned promptly to the foundation. So here the key terms, again, is if the foundation is not reasonably satisfied. That would be considered too subjective and again would not be a barrier. How about some more examples of the right of return language? So in our example here, under A, we can see the foundation reserves the right to demand the return of grant funds. So that's a pretty good indication of right of return. And then towards the bottom under B, the foundation may instead require the recipient to redirect the grant funds to another program or immediately distribute the grant funds to another organization. So both of those would be examples of right of return language. But again, keep in mind, if you would need to also have a barrier in order for this to be considered conditional. If they only had the right of return language, it would not be conditional and would be recorded at the time the agreement was signed. All right. So as we've talked about, many of our federal grants would be considered conditional because they can only be used for eligible expenses. And as such, kind of is indicative of a restriction. So under the standard 2018-08, there was a lot of feedback to FASB as this was going to require a lot of our nonprofit organizations to report more restricted revenues and releases of those revenues. Nonprofits, as you may or may not be aware of, have the opportunity to make an election, which is what is called the simultaneous release option. So under the simultaneous release option, contribution revenue that is restricted, in which those restrictions are met in the same period, can be reported as revenue without donor restrictions. So if a nonprofit makes that election, it's an all or nothing policy. If they make that election, they have to treat all of their restricted revenues the same. So in order to appease some of the feedback that they received on 2018-08, FASB included an option where nonprofits could make an election to treat just their conditional contributions as using the simultaneous release option. Since those restrictions are likely going to be satisfied at the same time they're meeting the conditions, they would be able to report those revenues as without donor restrictions. So this slide here is presenting an example of what that would look like under kind of the two different options. The top portion here is where a nonprofit does not elect simultaneous release option. So you can see the contribution revenue recognized would be reported as an increase in donor restricted net assets, along with a reclassification to the assets without donor restrictions to reflect the satisfaction of the restriction. The second half of the slide then is portraying an example of a nonprofit that is electing the simultaneous release option. So under this situation, they would be permitted to report that contribution revenue directly in the net assets without donor restrictions. So we just want to make very clear that if you elect this option for your conditional contributions, you have to apply it to all of your conditional contributions. You cannot pick and choose agreement by agreement which ones you want to present which way. So you have the option to make this election for just your conditional contributions, or if your nonprofit already includes a policy for all of your restricted contributions, may be reported that way as well. So disclosures, there were no new disclosures under 2018-08. We have seen, though, a couple examples where the required information under the old rules was not being included. So you need to make sure in your disclosure you're including both the dollar amount and a description of the type of condition. So we have an example here of what that wording would look like. So the first section talks about, how you're recognizing contributions. A conditional promise to give is one with a measurable performance or other barrier and a right of return, and those are recognized when those conditions have been met. Amounts received with conditions and restrictions are recognized as revenues that increase net assets without donor restrictions if those conditions are met and restrictions expire in the reporting period in which the revenue is recognized. So that is how your policy footnote would read. On our next slide here, then, we have an example of the actual documentation of the conditional contributions. So the first one here is the conditional contributions. We've got at December 31, 2020 and 19, this entity received contributions of $72,000 and $80,000 respectively. So we got our amounts. And they've not been recognized in the accompanying statement of activities because the condition on which they depend has not been met. The full amount is dependent on the donor agency meeting certain fundraising goals. So that's a description of our condition. In addition, this particular nonprofit had contributions of $1 million that weren't recognized due to a matching condition. So again, there, we've got the dollar amount and the type of condition, a description of the condition. The second half of the slide here then is giving you an example of what that would look like under the conditional cost reimbursement grants. So a portion of the nonprofit's revenue is derived from those cost reimbursable grants, which are conditioned upon meeting the certain performance requirements or the incurrence of allowable expenses. Amounts are recognized as revenue when they have incurred those expenses in compliance with the grant provisions. Amounts received prior to incurring those qualifying expenditures would be reported as refundable advances. In this case, the nonprofit had no refundable advances. The nonprofit received cost reimbursement grants of $89,000 and $58,000 that had not yet been recognized because of qualifying expenditures have not yet been incurred. So you've got the dollar amount again and the description of the condition. So for our entities that have a large number of cost reimbursable grants, this could be kind of cumbersome in order to keep track of or pull together all of this information. And one best practice that I have seen for one of my clients is that they are capturing this information on their CFA, so the Schedule of Federal Awards of Expenditures. They're adding a couple extra columns off to the right to list out what the grant award amount is for each of those federal awards, and then also a column to compute, the grant award less the amount of expenditures, the remaining amount that would be considered conditional. So that'd be a good way to capture the information that you need for footnote disclosure. All right, so we have talked about the revenue recognition, those exchange revenues, as well as conditional and unconditional type of revenues sources, and wanted to touch base a little bit here on some COVID-specific funding. So as we are all aware, there is a number of different programs that have been released throughout the year. We do not have time to go over each of them in detail. Today, we just kind of wanted to highlight some of the key ones for our nonprofits to make sure you're keeping them in mind and how they might affect your financial statements. The first one we have here is the employee retention credit. So this is a refundable tax credit, and that was for entities that either had a full or partial shutdown of operations in response to a government order, or they could have had a significant decline in gross receipts for certain quarters. At the time, the the credit is determined to be probable, so you've calculated it, and that that you will likely, it's likely or probable that you will receive a reimbursement, you would record the revenue. So it is the position taken by Eid Bailey as well as AICPA that would follow loss recovery guidance of ASC 410. So you would record that revenue at gross presentation. It would not be proper to net those amounts with your payroll tax expense. You would want to show them each gross. Similarly, on our slide here, we have the Higher Education Emergency Relief Funds. This is specific to our higher education institutions. This was emergency financial aid grants that were paid to students, as well as some institutional costs. These particular awards are subject to uniform guidance. They have to incur those eligible expenses under those cost principles. So that's your limited discretion and an indication of your barrier. And non-compliance with those could result in recoupment by the Department of Education. So again, you've got your right of return. So you've got your barrier and right of return. Those would be considered conditional. And as we just talked about, those conditions would likely lead you to believe that they are also restricted funds. But if you are electing that simultaneous release option, you would be able to report those as revenues without donor restrictions. We also have the shuttered venue operator grant, which is going to be pretty common for our performing arts theaters, movie theaters, live event operators, could be even certain museum operators, zoos, or aquariums. This was providing emergency assistance for eligible venues that were affected by COVID-19, and they were eligible to apply for a grant equal to 45% of their gross earned revenue. These amounts would also be subject to uniform guidance. Those eligible expenses need to be incurred in accordance with the cost principles of uniform guidance. So again, we have that limited discretion or a barrier. Non-compliance again could result in recoupment by the SBA. So we have the right of return as well. Those two items together would equal a condition, and similar to the HERF grants, would likely be considered restricted as well. Some other COVID-specific funding for our nonprofits is the provider relief funds. So there's a whole bunch of rules and regulations which are ever changing related to provider relief funds, probably most common for healthcare entities, but we may have some nonprofits that also have received provider relief funds. So wanted to mention that today. If you have those type of funds, we recommend that you get further guidance as far as your reporting requirements and when those would be subject to audit. They would also be subject to uniform guidance. So just depending on all the specific rules, when they would be included within your schedule of expenditures of federal awards. And those were used to prevent, prepare, or respond to COVID. Unused funds could be applied to lost revenue. So the Paycheck Protection Program, there was both the round 1 and the round 2. And as you may recall, there's 2 different models under which those amounts could be recorded. If they were recorded under the debt model, you would be recording the liability or the funds as they were received. You would be recording a corresponding debt. And then when the forgiveness was received, you would record debt forgiveness revenue. If you were applying those under the conditional grant model, you would record a refundable advance at the time you received those funds on your statement of financial position. And when you had received forgiveness, which would be considered the condition in this case, you would record the contribution revenue. You may have also received other state or private funding specific to COVID that maybe have been restricted as to use or time. It could have been for wages, personal protection equipment, or it could have been other COVID specific expenses. You would also want to look to that agreement to determine if you are a subrecipient or a beneficiary. If you are a subrecipient and it's federal funds that are being passed through, those may be subject to uniform guidance as well. So we wanted to kind of include this list here for you to consider whether you have any of these additional funds. Maybe in the past you have not been subject to a single audit because you haven't met that $750,000 threshold, but perhaps this year with some of these additional funding amounts that has put you over where you would need or potentially need a single audit. So we want you to make sure you are making those analyses before you get too close to year end so you can start planning for that and reaching out to your auditors. Another thing to consider as you are looking at all these different programs, is whether you have funds that could be claimed under two different programs. So for instance, if you are claiming wages under the Paycheck Protection Program for forgiveness, you would not be able to claim those same wages under one of the other programs or federal grants. So you need to ensure that you are not double dipping. Your auditors very likely will, when they come on site, ask you, how did you track this to make sure you weren't including those same costs under two different programs? So be ready, have those put together, your response, and be sure you're tracking that to make sure you haven't counted the same expenses twice. Also consider, how these different funds might affect your disclosures to your financial statements, how they may have an effect to the timing of your revenue recognition, how that may change your financial statement presentation from one year to the next. And start be thinking about that so you can present and prepare and report to your boards or your finance committees why things look significantly different from the prior year. So with that, we have time, it looks like, here for some questions. So one of the questions we have here is the valuation done as fair market value estimate if the organization does not sell advertising? And if the sponsor logo is just in the event printed material and on the organization website, is it all recorded at the time of the event and not deferred? So with that, you would really need to look at, what type of advertising is being done. In the particular example we gave, it was a separate newsletter. When you look into the specific rules relating to advertising, is there a call to action? There's lots of different considerations that go into it. If it's simply a sponsor logo in a brochure for the event, there likely is no defined benefit or would be hard to estimate the value received with that. Again, you're talking about potentially a very narrow window of people that are seeing that brochure, people that are attending the event. So again, it's really subjective to depending on what type of advertising is being done and how many people are viewing that advertising. The best way is if they're regularly selling it, you're able to specifically identify and assign a value to that. All right, so the second question here, is commission on concessions considered rent revenue and potentially taxable? So I guess it would depend on which entity we're talking about, if we're talking about the principal or agent, and how that falls within their mission. Typically, so we have a performing events venue where they have a cafe as well. And you would, if it was your customers that are coming to visit this performing events venue that are purchasing those goods and services, that would really be related to your mission and to your purpose, and likely would not be subject to uniform or unrelated business income tax. However, if that cafe was open to the general public and people could just come in and visit the cafe, that's not necessarily relevant to the purpose or of your mission. And therefore, those items might be subject to unrelated business income tax. If an agreement states it must spend in accordance with a submitted budget, would that be considered a barrier? In our experience, the answer to that would be no, because even within the budget, there's a broad spectrum of things that could be spent on. So spending in accordance with the budget would not be considered a barrier. How is a refundable advance different from deferred revenue? So that kind of goes back to one of our earlier slides. Deferred revenue are typically for those exchange revenue type transactions. Your refundable advances would be related to non-exchange or contributions. Would ERC be considered grant revenue? Also, what if you are waiting in line for payroll processor to start the claim? Do you wait until the claim is made or record revenue now, knowing you intend to claim? So the ERC, we're typically seeing, depending on how material it is to the nonprofit, we're typically seeing that reported on a separate line item. It could be, if it's not material, maybe it's included in other income. It would just kind of depend on the organization and the dollar amounts that they're receiving. If you're waiting for the payroll processor to start the claim, so when we kind of look back to that loss recovery guidance, really you're going to record the revenue at the time it's probable. And it's probable when you know the amount and you've done the calculation and you know the amount. That's the point in time when you would record the revenue. If you were waiting, knowing that you intend to claim, but you haven't calculated the amount yet, you likely would not record it because it wouldn't meet that criteria. If PPP is forgiven after the year end, but before the statements are issued, can you recognize as revenue in the current year? Typically, that would be no, because that forgiveness is really the triggering factor of when you would either you have the debt forgiveness under the debt model, that would be the triggering factor, and you would record it at the time. You would record the loan forgiveness at the time you received the forgiveness as revenue. If you're under the conditional contribution model, again, you wouldn't record that revenue until those conditions have been met. So you would not record the revenue until you received forgiveness. Will this recording and slides be available? Yes, you will. The slides are available in the chat, and they will, I believe, Amy, you can speak to that if they are included in the email that comes out afterwards with the recording.
Yes, they will both be available via email. They'll be sent to all registrants and attendees. Give us just a few days to get everything together.
So there's questions on ESSER, K through 12 entities, if they would be treated in the same manner as HERF grant, HERF funds. And I would have to double check my my notes here. There's lots of different federal programs, but essentially, if they are required to incur those costs under those cost principles again, they would likely fall under the same category and be considered conditional as well. So you would just walk through the steps, look through the requirements under those grant agreements. And with that, we are at our hour. If there are questions that didn't get answered today, we will try to answer those offline. We want to thank you for attending today as a part of our first of the fall series, and hope you can join us in the next couple of months. Our topics in October is nonprofit accounting and auditing update, standards nonprofits don't want to miss. And in November, presentation and disclosures by nonprofit entities for contributed non-financial assets. So that relates to the gift in kind new standards. So we hope you can join us then as well. Thank you for your time.